everyone, I'm Bella. After checking many life insurance policies for clients, I noticed that lots of them are in the dark about what they've actually purchased. They're not even familiar with the function of their policies. And when real-life scenario unfolds, some find themselves without the coverage they thought they had. Isn't it frustrating when you have the right mindset for personal protection but aren't fully covered because of choosing the wrong policy? So today we'll talk about different types of life insurance and check out what they're all about. Basically, there are two main types of life insurance: term life and permanent life. Before we get into the details of life insurance policies, let's quickly explore the background to understand how life insurance has evolved in the US. The landscape of life insurance in the US has undergone changes across various eras, typically evolving every decade to meet different needs. The earliest life insurance offerings included whole life dividend policies and what we now refer to as term insurance, which is consumable policies without any cash value. In the 1970s, due to low interest rates, government bonds were lower, so the whole life policy performance suffered. In the 1980s, a new product emerged known as universal life, offering more flexible interest rate and more reasonable cost of insurance. During the 1980s, when short-term interest rates were high, universal life was suitable. However, as short-term interest rate began to decline in 1990s, universal life lost its appeal. During the 1990s and early 2000s, variable universal life gained popularity as the stock market performed exceptionally well. However, following the market downturns in 2000 and 2008, with the realization that both growth and security are vital, a new product emerged, which is linked to the performance of the stock market and offers a minimum guaranteed downside protection. Now that we've explored the evolution of life insurance, let's delve into the functions and advantages of the product that emerged in each era.
Term life insurance.
Terms provide coverage for a set period, like 10, 50, 20, or 30 years. Once that time is up, the policy ends. If something happens to the insured during this period, they're covered. However, if nothing occurs and the term concludes, there's no leftover value because term life insurance doesn't accumulate cash value. The upside of term lies in its lower premium compared to other policies. But here's the twist. As the term comes to an end, your age goes up, and that will result in a higher premium. So if you're in a high-risk job and not concerned about cash value, term might be an affordable and preferred option for you. However, if you desire both longer protection and the ability to save money in cash value, permanent life insurance is a better choice than term.
Permanent life insurance.
When it comes to permanent life insurance, think of it as creating your personal account with a life insurance company. When you contribute money, known as the premium, a portion goes towards covering your insurance costs, and the rest goes into your cash value account. It's like growing your insurance saving while making sure you're protected. The two main categories of permanent life insurance are whole life and universal life. Whole life ensures a guaranteed death benefit and cash value growth. On the other hand, universal life offers greater flexibility. Whole life offers lifelong coverage with consistent premiums, building a cash value over time and ensuring a guaranteed death benefit for beneficiaries. The policy may also yield dividends. While traditional policy premiums were paid until insurance passing, the modern policy provides flexibility in payment's duration. However, once the policy is purchased, the chosen payment period remains fixed and cannot be modified. Universal life provides increased flexibility, allowing you to adjust both the death benefit and premium payments within certain limits. Similar to whole life, universal life policy also accumulate cash value. And as life insurance adapts to diverse needs, various universal life policy options are available. But today we'll only talk about two of the most common policies, VUL and IUL. VUL interest is tied to the market selected by the client for investment, combining insurance protection with an investment function. During favorable market conditions, profit can be substantial. However, it's crucial to acknowledge the associated risk, as downturns in the market could result in losses. The main distinction between VUL and IUL lies in their approach to investment. In VUL, your money is invested directly in the market, meaning you may experience losses if the market drops. On the other hand, IUL operates differently. The insurance company doesn't invest your money in the market. Instead, they provide interest based on market performance. When the market rises, you receive a better rate, and if it drops, your investment is guaranteed not to incur losses. Another notable advantage of IUL is its flexibility and cost of insurance compared to whole life. While some clients opt for whole life for its guaranteed death benefit, it comes with a higher cost of insurance and fixed payment. Withdrawal from whole life policy can also impact the policy's guaranteed benefits. However, IUL offers a solution by providing death benefit for your beneficiaries while enjoying flexibility in payment adjustment and lower insurance costs. IUL's affordability and flexibility in modifying payment amounts and schedules make it a comprehensive solution. Being a relatively newer policy, IUL is crafted to meet the different needs of diverse range of clients. Naturally, if the insurer is younger, the cost of insurance is lower, and the funds deposited into the cash value account benefit from compound interest more effectively. After exploring various types of life insurance, do you know which policy you currently hold? If today's video has provided valuable insights, welcome to share it with friends who are also interested in understanding life insurance. If you're still uncertain about your existing policy or don't know what you've purchased before, feel free to send me a message, and I'll be happy to assist you with a complimentary policy review. For additional information, check the details below. Happy New Year and see you next time!